Emmanuel, of course, needs no introduction. I think he's been for 28 years running the Asian Banker. I'm sure all of us know him. He has now finally put his thoughts into writing in this book, and we look forward to hearing more about it.
Firstly, I want to say thank you to all of you for being here. I'd like to thank Barney Frank for being here. He's been a very dear friend for several years now, and it's very interesting that the conversations that we've had together resonates at the back of my mind, even as the current developments are unfurling in the US. The interesting thing about this book is that I titled it The Great Transition because finance is undergoing a great transition. But in terms of a choice of a book title, if you typed in Great Transition into Google, you'll see that all the other books with the same title are about the afterlife. So you've got to type in The Personalization of Finance is here to capture the full story. Okay, so remember this if you're writing a book in the future, and to check who else has got the same title. Let me start by quoting from a phrase that I learned as a teenager by a German writer, Wilhelm Rabe, who said, "The eternal is hushed and still, the temporal is strident and loud. Silently over the strife on earth moves the will of God." It's not because it's it's not in any way religious. William Rabe was more of a writer of things that are going on the ground, and it was for him to pick up ideas that will have an enduring influence on society. And he wrote substantively between 1850 and the early 1900s. And these were incredibly formative years in European history. Just as many things that are happening today at the geopolitical level, at the industry level, and technology levels are incredibly noisy. And it's very difficult for us to identify the substantive issues that we need to put our fingers on that will help us understand what are the enduring trends that we need to be mindful of, instead of getting caught up in what's happening next, and then next, and then next. Now, with that in the back of our minds, if this was 2007, something that we would have been thinking about, and if we were having this conversation in 2007 and I asked you what's top most on your mind, you're probably thinking about the financial crisis, about Lehman Brothers, Bear Stearns, and the news unfurling as it was happening. I remember I was at Cybos when Lehman's went under, and we were all talking about it, the banking community, and what the implications were. GE and Basel III. I mean, if you're operationally, banks were thinking about the implementation of Basel III. But look at the number of things that were happening in the background that eventually came to define 2007. The iPhone was invented. Facebook went online. YouTube was invented. Netflix started. Google started Android. And all of these had far more substantial impact on our lives in the way we live today than any of the macro issues at the economic level. And Bitcoin was born in 2007, 2008, in that period. So we look for the issues and the developments that are going to have an enduring theme in our lives. So today, if we ask what are we worried about in 2023, or what do we concern ourselves with, the reason we invited Barney Frank is because we are all very interested what happened to Signature Bank. We're all very interested what happened to Silicon Valley Bank and what's going on at Credit Suisse and so on. And we are all very interested in the trade war between China and the US, about Ukraine. That's the big topic. But guess what's happening in the background? The cost of genome extraction has collapsed from about $1 billion 20 years ago to something that you can buy on 23andMe for less than $1,000, $900, $700. We now can edit genes to a level of precision that helps scientists deal with cancer and a whole range of diseases. Satellites, reusable rockets, we're thinking about living in space for longer periods of time. Yesterday I saw a fund that was created to be able to extract minerals from asteroids, and they say that that's possible in 20 years' time. And those are the kind of issues that we're going to be affected in our lives and in the way in which we live in the future. Neural language processing, of course, has made ChatGPT and GPT-4 available to us. And the questions we are asking today is, what will work look like going into the future? Now, in writing this book, in putting it together, and even creating this dialogue, the people that I've had the opportunity to work with, who wrote the foreword to my book, are some of the most incredible people that I want to acknowledge as I start this presentation. Barney Frank, of course, the co-author of the Dodd-Frank Act. To be honest, for someone who's from Singapore, to have had the friendship of the man who co-authored the legislation that dictates the banking industry is a matter of deep pride and honor for me. But at the same time, my friendship with Barney is not all roses. We have some of the most interesting debates, and the phrase that Barney uses on me all the time is, compared to what, Emmanuel? Because I come up with ideas that he pushes back on, and he thinks, and he has to put in context in terms of how legislation is put together in the US and what he thinks the banking industry is like. The other person that I like to acknowledge is Richard Sandor, who wrote the second foreword to the book, and Richard had some interesting things to say in there. And Richard is the father of the interest rate derivatives marketplace and the father of the climate bond marketplace that we know today. And some of you here, as you start your own marketplaces, your digital exchanges, your trading platforms, I think about what Richard had achieved in his career, and he's hardcore Chicago open economy school, and the friendship that I have with him, and to get the validation from him that the things that I'm writing about in my book are things that he resonates with. And we had Ron Shadlin in the US. Today we have Alex Manson. The friendship that I have with Alex Manson is very interesting. I want to just mention that I want to take that a little further. But before I say that, someone that I came to know through Barney Frank was Scott Shea, the CEO of Signature Bank. And I was probably one of the two people who ever had him on video. You can see this on my YouTube channel, that I had a conversation with him, and he described to me Signature Bank 3 years ago, and how it was honest to goodness downtown New York bank that was very closely connected with the local community, and that it was taking an approach to cryptocurrencies to invest in the future and see what it is that we are dealing with today that is incredibly dramatic. And so that friendship is also something that I could draw on. Coming back to Alex Manson, again, a friendship that is forged in the fierce battle of ideas. Every conversation I have with him at the coffee shops, I throw an idea at him, and he responds, which I think comes from a traditional banker looking at innovation. And the reason I respect him immensely is because despite being a traditional banker, he invented Standard Chartered Bank's venture capital platform. and he takes a position in a lot of the disruptive technologies that are potentially going to be disrupting his own bank. And therefore, he needed to be intellectually honest and rigorous in the way in which he assesses these technologies. And I find Alex an amazing friend at a personal level. I love the way he looks after his family. And if you look at his Facebook, he's out there cycling 150 miles around Singapore, and he does all the triathlons around the region and so on, and how he finds the time to do all that and to read my book in its entirety. And the interesting thing about after having read my book was, Emmanuel, surely you are basing your book on this book, which is The Sovereign Individual. Okay, and I was shocked when he introduced to me this book 6 weeks before my book went to print. And I said, no, I've not read this book at all. And what was both endearing and also helped me to put in perspective my own thinking, just before it went to print, was that the idea that the individual is being empowered in the information society is already out there. We are now entering a world where technology is empowering the individual with not just information, but the ability to own its own transactions. And that is transforming and disrupting not just finance or any one of the industries, but society itself. And so that's what this book is about. And I almost recommend that as a corollary to my book, because I come from the finance angle. I looked at money as a token, as an exchange of value, and how, as it's being disrupted, it's going to be disrupting all of society. And the conclusions that I came to in my book are somewhat congruous with the conclusions that are described in this book, but from a much more broader angle. Now, each of you have been given a copy of my book for the sole purpose that you're going to go into Goodreads or Amazon or into Google Books and write your own reviews. Okay, I want you to be honest, as I'm expecting our panelists to be honest in terms of discussing the things you agree or disagree from my book. And I do not write a book in order to be right. I write a book in order to put out an idea out there so that it can be torn apart, discussed, and brought to life in the way in which each of us have a takeaway from what you think you're reading in it. At the same time, it's my record of what I'm thinking today. I might change over time, but having that record helps me to track my own transitions in my thinking. Now, the book, of course, looks, formidable to anybody who's trying to navigate it. But the one way to map my thinking in the way that I've written my book is to map how I've developed the book. And by the way, this book was my first book. I now feel very confident that I now can write subsequent books. But I needed to get the first book out because it was a huge struggle inside my mind as to what is it about the future of finance that I can say that's not already been said, and what is it about the future of finance that needs to be said that requires someone who sits one step removed in order to write this book. So the first part of my book, I deal with some fundamental assumptions or fundamental dimensions. I put together the dimensions in which we need to think about the future of finance. The second part of my book, a lot of it has to do with bankers. And going back into the history, the geography, the economics of banking, and trying to recapture the substance of banking as it's being transformed into the digital age. And let me tell you this, banking is a beautiful industry. It's an industry that is sustainable only when it's predicated with its roots firmly embedded in society. And banking gets its energy from society, its sustainability from society, and its relevance from society. And that's what I've been able to capture, because some of the stories that I had to go back into to try and recapture that. I think about Teh Hong Piao of Public Bank in Malaysia. I think about Hang Seng Bank in Hong Kong. I think about Grameen Bank in Bangladesh. I talk to community currency people in Kenya. People who are doing grassroots work, who kept faith with their local community, and that's where banking secures its substantive value, and that's what we're trying to protect and build on into the future. So a lot of the center of the book goes back to first principles to try and figure out what are the DNA elements of banking, and then project that into the future. And then as I was finishing the book, I said to myself, oh my goodness, if finance is becoming essentially individualized, it's going to have an incredible impact on society as a whole, in the way in which entire societies are organized. And that's where my book resonates with what was said in The Sovereign Individual. And regardless of which countries that we come from, I spend a lot of time in China, which from the outside looks like is a very organized and a very dictated society, but even China is evolving over time, and even China is going to be disrupted by the technologies that are disrupting finance today. So now let's just go through some of the points that I put together from writing the book. Now, as I built my thought patterns in the book, I came up with some themes, and I want to be able to share with you some of those themes today. I talk about from platforms to personalization. I talk about the personalization of finance. I talk about the mass amateurization of finance. I talk about the financialization of everything. These are phrases that I put together, which over time they're going to find their way into Wikipedia and so on, because I want to build on these ideas. The financialization of everything. The liquidity that sits outside the institution, rather than the liquidity that we preoccupy ourselves with if we are running banks, with the liquidity that sits inside the institutions. And then I borrow an idea from another writer who talked about how society itself transitions from tribes to institutions to networks. And I end the book by trying to imagine what the next financial crisis is going to look like, because that sets the stage for bringing all of my ideas together. Not that I want to predict the next financial crisis, I just want to say what the elements of the next financial crisis will look like. Now, I start my book with the story of ICE. And the reason is, when you're writing a book, you want it to be as accessible to as many people as possible. And so the story of ICE helps the layperson to understand the transformation that finance is going through. And ICE, just imagine this, was once something that you soared out of the lakes of Michigan or out of Boston, the lakes in Boston, put it on horse-drawn carriages, and carried it all the way to New York, which then finds its way into your glass of gin and tonic or whatever application you want to use it for. And that's what ICE used to be. Today, what is it? What is ICE? It's something that we generate in the refrigerator when we want it, how much of it we want, and how we want to use it. Now, what made that difference? It was refrigeration technology. And what is the essence of refrigeration technology? It started with a chemical called CFC, chlorofluorocarbon, which today is banned, but that's because we have other alternatives which are more environmentally friendly. But the idea in finance is to find the chlorofluorocarbon of finance. And what is finance today is exactly as what the ICE trade used to be. The money in your pocket could have swirled around the world twice, undergone inflation, exchange rates, bank charges, security, and a whole range of other factors before it gets to you. So none of us are in control of the value and the use of the money that we use. And ICE had that origins. And we are now moving into a dimension where we will be incredibly in control of money. And we are moving in that direction. How long we get there is not very clear, but it's a journey. And having a sense of direction helps us to make a judgment call on all the technologies that will help us get there. Now, so in the first part of the book, the thing that I'm saying most importantly is not even directed to the people in the banking or finance industry. It's actually to technology in general. I'm saying to the technology people that the era of the platform age is eventually coming to an end. And the people who don't believe what I'm saying are the platform people themselves. I gave a copy of my book to executives in Google, and they just threw it back at me and said, no, that's not going to happen. And that was before ChatGPT, by the way, right? And if you worked in Google, you would never imagine a time, no matter how short the Google's own history was, that there will come a time where Google would be disrupted, which it is right now. Now, what the people in the platform industry don't realize is how the platform industry itself had undergone several transitions. In the original iterations of Amazon, of Google, a lot of the platform industry was desktop bound. And the 2007 period that I talked about was when the platform industry went mobile. Now, what was interesting is in the 2007-2010 period, the success of Facebook almost disrupted it from making that transition into the mobile age. In fact, it was Alipay and WeChat that made that transition much more native than the original platform players, right? And it's funny that the Chinese were very bad starters when it was desktop bound. You had Renren, you had QQ, which if you look at it today, you'll think that it's just not usable because it's not user friendly and so on. But because they were not native to the mobile era, when the new mobile players came on board, they swam in it like fish in water and took it to a whole new level. Were non-religious about micro apps sitting in super app and so on, which the original players found it very difficult to make that transition. In fact, when you see what Elon Musk is trying to do with Twitter, he's trying to recreate Twitter by being native to the mobile era and the new era that's going to come through, which is Internet of Things and device independence, which is a whole new era that we are at the cusp of right now. And in the same way, like when you think about some of the issues surrounding TikTok, TikTok is native to the mobile era and it uses a lot of visuals, and therefore it's taken the DNA of the platform era one step beyond what Facebook and LinkedIn and all of the other social media platforms are able to do. But the history of TikTok is also going to be short-lived. And that's why sometimes I think about the discussion on TikTok is unnecessary, because TikTok itself will become, a victim of the metaverse and multi-dimensional realities and so on. So this is what I'm saying to the platform people. Now, what's interesting is that I find is that a lot of people don't realize there's a fundamental difference between Web 3 and Web 3.0. If you Google for the meaning of these two, they sound almost the same. But I know the individuals who promote the two different views. Web 3 was written as an idea by the co-founder of Ethereum. It was a blockchain-based idea. And Web 3.0 is an idea that is being promulgated by Tim Berners-Lee, who is the person who wrote the code that set up the HTTP platform that we all use today. And there are two different realities that are in competition with each other. It is not clear yet which reality will become the defining structure in which human society will interact. Because if we go on with the HTTP view, then all of us will have to share our data on a shared platform. If we take the blockchain view, we all become platforms of our own. And that's a whole different reality that we're going to be faced with. Now, I'm saying a few things as I say that. Now, although the views that I am promoting, or the views that I'm sharing with you may appear a little high level, I'm constantly thinking about what they mean to us as business decision makers in this room or wherever it is that you are. One thing I'm saying is that the whole idea of financial inclusion as a theme is a lie. Okay, and I say that very vociferously in my blog, that every time I hear a platform player say, I'm doing this because I want to add financial inclusion, I say that, no, your financial inclusion is not as benevolent as you make it out to be. Why? Because the whole idea of financial inclusion is to onboard millions of users and then monetize them, because your investors require you to do that. And all the microfinance, the lending, the financial inclusion projects that I've looked at, the interest rates have not gone down. The interest rates when Grameen Bank started its physical model of lending to 6 women in a village was about 28 to 30%. It's still 28 to 30%. So the people who are promoting financial inclusion haven't brought their prices down at all. And if the idea is to get people who are not leveraged to come on to the formal economy and then to leverage them, then you're not creating wealth. You're actually spreading poverty. I'm saying that it's digital access that we want to promote, that the poorest person in the world has digital access, that he then can decide how he wants to interact with the rest of the world and helps him plug in to the global economy. I'm saying that platforms will become ubiquitous, but everyone who is going to be on a platform is not going to be profitable. And I have in the back of my mind digital banks when I say that. Now, in the middle of the book, as I talk to the banking community, I'm talking about the financialization of everything. What do I mean by that? Anything that can be turned into data can be financialized. And in 2014, I think it was, Jeff Immelt of GE said that the future income of GE is going to be in data, not in manufacturing. So by collecting data on all of its manufacturing processes and all of its supply chain processes, that's going to be the source of GE's balance sheet going forward. And I think that when you think of any new equipment, any new autonomous vehicle that collects data, it's the data that is going to be the asset that generates value. In fact, the US economy itself is being redefined from manufacturing and then to services and then to intangibles like entertainment, brands, and so on, and then into data. And I also see that as countries become increasingly indebted, as they issue more debt, it's the trading of that debt that generates income. So we're moving into a world where we're going to try to financialize everything. We're not going to be able to financialize everything. I give the story that mankind, eventually tamed only about 17 of animals that are more than 100 kilograms in weight and higher. It's not that tigers and lions cannot be tamed. It's just that it's not economically viable, necessary to tame them. And then there's zebras didn't get tamed, but horses did, and so on. So we're going to go through a phase where we're going to try to make into data a lot of the assets that we have today, but only some will become tradable and financialized. And that's the journey that the world is going through in the next many years. And the thing that's about financial institutions, as they get disintegrated, or rather their roles get redefined in going into the future, financial institutions will find that the data that sits outside the institution becomes more important than the data that sits in the institution. And that's something that banks haven't figured out yet. I want to talk a little bit about the mass amateurization of finance. As technology evolved into APIs and greater democratization, where because of open source computing, anyone is a programmer, it's a phase in the evolution of technologies that banks missed. Because if you look at the way in which the banking industry treated the API industry, it wasn't the same approach as the technology vendors did, which was to allow 6-year-old kids to go onto a gaming app and build their own games. Banks treat API vendors as, I call them patch solution vendors, basically, to come in and solve small problems in the bank. When in actual fact, banks should be allowing everybody to have access to plug into the institution. Now, having missed the API revolution, the API revolution is now morphing into the crypto space, into the personalization space, and banks will have to do an incredible amount of rethinking to try and figure out how to plug into the data that sits outside the institution rather than the data that sits in the institution. Now, as I then go into the last part of the book, I'm asked this question: so how should people in the finance industry think about the future and think about what they need to focus on and build on? And this is the part that was very difficult for me to suggest and put in my book and build the confidence that it's an idea that is worth pursuing. I'm saying to banks, give up your most beloved products. And that's not easy to do. We all think that the deposit business is the most important product in the banking industry, and the lending business is the most important product in banking. And if you look at the balance sheet of most banks, it's the mortgage business that makes up easily 50 to 60% of their portfolio. Now, Ken Ragoff, I think, wrote this book, This Time is Different, trying to suggest that in finance, things don't change. If you look at the history of Basel regime and how it's evolved, things have changed. The first Basel Accord in 1984, and actually the FDIC chairman Bill Seidman said this to me. He said that Basel I took 1 day to decide. They all got together, and within a day they decided that it will be 8% capital against your total assets, and that's it. That's what all banks should have on their balance sheet. And what was the bank's balance sheet at that time? 60-70% of that was mortgages. And what kind of mortgages? Real mortgages of real houses that sat on the balance sheet. And over time, the world changed. I think that when you juxtapose how Basel was developed over time, and you look at the crises that defined that, there was Black Monday in 1987. That was a securities crisis. It was a markets crisis. And guess what? The banking industry figured that getting into the securities industry, holding securities assets, was a good thing for the bank. It added to the profitability of the institution. And so when Basel II came about, they added credit risk, operational risk, and market risk as a dimension for risk management and capital adequacy and protecting the institution. By the time Basel III came about, and that was the result of the 2007-2008 crisis, the balance sheet started looking even more different because by that time, what banks had on their balance sheet were derivatives of derivatives. In other words, they don't even own the underlying assets anymore. Now, and trading risk and a new form of risk, which was counterparty risk. This is, to me, the banking industry's entry to the networked community, which is that you can have systemic risk in a way that didn't exist before because of the way in which banks were trading, but not just trading, a lot of the trading was between themselves, with each other. Now, if that's the trend, we can already start trying to figure out what Basel IV might look like. With the Signature Bank and the Silicon Valley Bank crisis, what crisis was it? What's the name that we're going to give this crisis? The digital risk crisis? It's a digital risk in two forms. One is the asset itself, which, by the way, I think we're going to have this conversation afterwards with Barney, which is that the digital assets didn't show up on the balance sheet of any of these banks, including Silvergate. Although Silvergate was a very powerful player in creating the on-ramp, off-ramp transactions, right? And so what Basel regime is showing us is that the balance sheet of the financial institution is becoming increasingly esoteric. It is not built on fundamental assets anymore. Now, so then the question is, if you're asking me, how then should banks reimagine the products? How do we even start doing this? And actually a related question in there was the question of why is it that the fintechs that started wanting to disrupt the banks and close them down today are applying for banking licenses more and more? Now the short answer to that in my book is that because they were selling the same products as the banks were. If you are a peer-to-peer player who is selling mortgages, it's just a matter of time before the regulator gets to you and slaps on you all the same rules as they have on banking. And then it comes clear to you that the best thing for you to do is to apply for a banking license. But let's look at the deposit business. It's a business that you never think will be disrupted. But what was deposits in the old days? And that's where the middle of my book is very important, because I'm calling back into memory what the deposit business used to be. The deposit business used to be the lowest cost of funding and the safest source of customer base in any community. If you go to any country, land at the airport, look at the balance sheet of the largest bank in the country, they have the best deposit base, the lowest cost of funding. Public Bank in Malaysia and Hang Seng Bank were world leaders, not just Asian leaders. And that's one of the nice things of being Asian, is that I can see the world in the US and in Europe from here, and then take a position that is much more broader than if you're looking at the world from there, looking out. And their cost of funding, their cost to income ratio was like 30%, and sometimes even less. And there was a banker in the US whom I know very well, Vernon Hill, who started this bank called Commerce Bancorp, and he was the most efficient collector of deposits. Efficient collector of deposits also means that you know your depositors personally, and they are also therefore good credit customers because you can build your credit book safely and you can scale. During the time when Public Bank was scaling its loan book 30% year on year, the other banks in Malaysia were looking at them and thinking, how can you do this without getting into trouble? And that's because it had a very strong depositor base. And Vernon Hill in the US, by just allowing people to bring in their dogs to the bank branch, having coffee and having money-changing machines, became the most efficient deposit-taking business in the US. And he didn't even build a lending business. In fact, he built a balance sheet that was reinvested in treasury bonds, just like Silicon Valley Bank did. And the funny thing was that in the US, that was the best thing you could do with a low-cost deposit base, which is collect as efficiently as you can, put it into treasury bonds, and go home and sleep, or go play golf. And that used to be the best thing you could do. And today, even that is being called into question. And then what happened? Digital wallets the platforms started to become more efficient collectors of deposits than the banks. The digital wallet business, I think total bank deposits now globally is like $230 trillion. Digital wallets like $20 trillion at the moment. There was a time when deposits were growing at 60% per annum, and now it's in total decline, especially in the US. And digital wallets are growing 20%, 24, 25% compounded annual growth every year. So the platforms are becoming more efficient collectors of deposits. And so banks have already started to becoming disintermediated on the deposits front. And then the question is, what are the new platform players doing with the deposits? Banks don't give good interest on the deposits in the first place. I mean, to go to the ATM and withdraw your money, your taxi fare wipes out the interest that you were being paid. And what do the platforms provide in terms of the deposit accounts? Great connectivity for a whole range of digital applications that makes it important for the user to have their deposits on these platforms in order to run their everyday life. And so the reason for the deposit business has evolved. And where is the deposit business going? It's going to a point where deposits will no longer need to be a balance sheet, a digital expression of the balance sheet position of your account with the bank. That's what deposits are today. They can become tokens that you don't even need a bank to hold. And that's what the future is looking. Now, I've not said the word cryptocurrencies at all in my presentation because I'm not coming from that world. I'm coming from the traditional banking world and looking at the transitions as they're taking place. So what I'm saying to the banking industry is this. Remember Kodak? They invented digital film in 1995 along with a few others. Guess what? They loved their 35mm physical print film right into the 2000s when Sony introduced the digital camera, the CyberShot, and 2007 when the iPhone enabled greater photography to be done on the iPhone, and 2010 when Kodak went bankrupt. So it is possible that even on the most honored of banking products, the banking industry is being disrupted. And maybe that's what the conversation we need to have with Barney and with Alex afterwards, which is that what happened at Signature Bank? Not only is there such a thing as too much deposits, in fact, it was Jamie Dimon who said that who introduced this term that I have in the back of my head, which is excess deposits. In other words, deposits that the bank really doesn't want to have. It's a business that gives the bank more trouble than it's worth. So we've already entered that realm. And now we're entering a realm where the deposit is something that the user needs to use, not in order to earn interest or generate wealth, but to help him connect in a whole range of utilities. Now, so what I'm saying in the future of deposits is also that it is very likely that the best issuers of stable coins in the future will be traditional banks. Imagine a world where every bank issued its own stable coin and competed with each other on the utility of those stable coins. What is the stable coin's biggest problem today? It is that it doesn't have the governance structure to warranty that the value of the stable coin is what it says it is. And which are the institutions that have the best credibility to build that governance structure? Banks. So I see that there will come a time when the best issuers of stable coins will be traditional banks. Okay? Remember I said this. It's not whether it actually happens, but that's the direction in which we are heading, and anything that happens will be a variation of that. So as I finish, I actually borrowed an idea from, you'll see this in the last chapter of my book, from a RAND Corporation analyst, and he's an elderly man right now living in the UK, David Ronfeld. And he said in 1994 that society goes through 4 transitions, from its tribal to its institutional to its markets and to its network phases. I found this model very transposable into the banking industry. When I looked at what happened in the LIBOR crisis, I thought it was a crisis of transition rather than a crisis of deception. It was a case of the markets players, the traders, looking over the institutional players, the rate setters, and looking for indices that they can use in the markets. And that's where the discrepancy took place. In fact, think about this, almost nobody got convicted for a duty of care to the other to this day. Okay, and the one conviction that happened is being reviewed in the UK courts right now. Right? So the thing is that as we transition from one phase to the next, there will be disruptions that we need to deal with. And I'm saying that there will be more cases of LIBOR type instances as we transition from our markets phase industry today to networks. Now, when you think of something like cryptocurrencies and the way they're talked about, as long as you're talking about them in the market space, in other words, the trading phase, that means that willing buyer, willing seller, I have a price for it, you exchange that token, that asset with me, all the rules of the market space apply. So what Charlie Munger says about crypto is correct, as long as you're dealing with it as a markets instrument. But crypto will have a different function, a different value when it moves into the network phase. There, it's not the price of crypto, but the fact that each one of us, even today, can issue our own crypto, put it out there in the market, and see who else would want to transact with us. So these are the thoughts that I have in my book. They're all original thoughts, or thoughts that are hedged on original ideas that wants to speak to an industry in a way that it's never been spoken to before, takes a high-level view, but with an intention of creating a roadmap that we all can use to guide us in our journey.